Let's get down to business in terms of some of the sectors that you like and why you like them, and some of the ones that you'd stay away from.
Okay, so the first and foremost, you've probably heard it, stay away from emerging markets for the time being. They may get cheap, but for the time being, they're not cheap. The sectors as well that we don't like and we think we won't like in the near future include mining, metals, commodities, oil and gas. Now, oil and gas in the States, we think there's built-up, pent-up bankruptcies in a lot of the smaller oil and gas guys. Not the majors, but we think a lot of smaller companies may go under. So if you're thinking like a hedge fund, guys, some shorts in the U.S. high-yield market might be not a bad idea. Sectors we do like, let's see.
So you're saying like rig count is going down, things like that. That's going to impact some of the services companies in the oil services sector.
Yes, and the cost of production is above the sale price. They're using their balance sheets, the fact they have a lot of debt, they're kind of extending. It's called amend and pretend in bond terms. They kind of extend, the banks play ball, they try to keep paying the interest but not the principal, but there comes a time when they cannot pay the principal, and the value of what they have in the ground is no longer good collateral. In other words, if you have $100 million worth of gas in the ground, you borrow $50 million, you're not really that leveraged vis-a-vis your asset. If your asset goes to 40 million from 100, your actually loan to value is 100% without anything changing, and your extraction cost is higher than your sale price. So you're not in a good place as a borrower.
Okay. And you like
yes.
a whole bunch of other things.
So like financials, banks make money when they lend money, especially when higher rates go up. When rates go up, the spread is higher. So financials will do well.
But that's going to take a long time.
Yes, it might take a long time. It depends on what the Fed does. Should we call and say and get them to hurry up?
Yeah. Well, no, not really. I don't know.
I don't think it's a good idea to call the Fed, but okay.
Yeah.
But okay, second order effect, real estate market. I continue to like British and continental real estate. I think there's an article a couple of weeks ago in the FT saying that it was Norway, Germany, and London. So all of Germany, most of Norway, and basically London, and three biggest growth markets. I like tech. I continue to like tech. You see the Apple, all you have to do is call Kramer and the price will go right back up.
Apparently.
Sorry, you have to be the CEO, but okay. Joking aside. M&A. M&A is going to be a dominant force. Companies want to buy other companies while they can, while debt is cheap. Pharma, it's just like every day I open the paper, I look at a multi-billion-dollar pharma deal. I've seen some insurance, RSA. I'm seeing one of my top picks is going to be Gala. Gala Coral is a UK debtor, basically bingo halls and gaming and gambling. Inelastic demand, consistent returns, and they're merging. So we're starting to see kind of the landscape changing, but the good companies are merging with okay kind of targets to create decent companies with decent balance sheets. And one of my last picks is Wagamama. Anyone who lives in London, it's a franchise, very well run, of fast, clean Asian food. When we looked at them, they build their own spec. They have their own, basically, information systems. They use just-in-time technology. If they're not selling any food, they start to give it away free to create demand. If the store doesn't work, they close it. Very tight, well-run ship. You can get 7% on these bonds. Okay, you can get 7% in sterling. Wagamama and Gala, for example. So I'm thinking on the debt.
Yeah.
So let me be a little clearer. Yeah. Equities might be volatile going forward. Look at European corporate debt because there are some opportunities to earn decent yield without taking market directional risk.